Welcome to a deep dive into the world of trading. We're going behind the scenes with Jack Schwager's The New Market Wizards.
Awesome.
You've shared this with us, so we know you're not new to the market.
Right.
But this goes beyond just like basic charts and strategies, right?
Yeah.
We're talking stories and philosophies from like legendary traders, the kind of stuff that can totally change how you see risk and reward.
Definitely. It's really inspiring stuff.
So are you ready to unlock some secrets from these market masters?
Absolutely. Let's dive in.
First up, a market most people don't realize is the biggest in the world. Currency.
It's wild when you really think about it. We hear about stocks being huge,
Yeah.
but
Yeah.
currency, it's on another level. Trillions, with a T, being traded daily.
Trillions. That's insane. Is it all just big companies moving money for international deals?
Well, that's a big chunk of it, yeah.
Okay.
Companies doing business overseas, they got to protect themselves from exchange rate swings.
Right.
So let's say a company needs to pay for stuff in euros a few months down the line.
Okay.
They might buy those euros now to lock in the price. That's hedging.
Makes sense, yeah.
Hmm.
But I'm guessing it's not just companies being cautious. There's got to be some speculative action too, right?
Well, absolutely. Wherever there's volatility, there's speculators.
Right.
And currency, it can be volatile.
Yeah.
That plus the sheer volume makes it a really unique playing field.
Which brings us to a trader who thrived in that field, Bill Lipschutz, the Sultan of Currencies.
Oh, yeah, his time at Salomon Brothers. Legendary.
$500 million in profit for them over 8 years.
It's not just the amount, but the way he did it. He really understood global economics and how to read those subtle cues in the market.
There's this story in the book that really shows that Schwager's interviewing Lipschutz, and right in the middle of it, Lipschutz buys 20 million Australian dollars.
Wow.
He felt it was oversold and was going to rebound.
Mm.
I mean, what do you even make of a move like that?
It shows just how fast currency markets move, right?
Yeah.
Blink and you miss it. You need gut instincts, quick thinking, and the guts to actually act when you see something.
So, what can we learn from how Lipschutz traded? It sounds risky, but there must be more to it. What made him so effective?
Well, one thing is how he scaled in and out of positions.
Okay.
So rather than going all in at once, he'd start smaller and increase as the trade went his way.
So testing the waters.
Exactly. Limits the losses if it goes bad.
Smart.
And if it's going well, gradually scale up to maximize gains. It's a balance, risk, and reward.
He wasn't just riding a trend blindly, though, right? He seemed to always be reevaluating.
You got it. Even when winning, you got to stay adaptable.
Right.
Lipschutz never assumed a trend would last forever. He was watching for changes, reevaluating based on new info and price action, and ready to adjust.
That takes discipline. It almost feels like emotional control is as important as market knowledge here.
Lipschutz is a perfect example of that. It's a big theme in the book, actually. Mindset matters as much as strategy. Like, there's this trader, Ed Seykota, with a really interesting philosophy. He said, everybody gets what they want out of the market.
I'm intrigued, but not sure I follow. What does that even mean?
It means our emotions, even the ones we don't realize we have, are driving our trades. Fear, greed, wanting to be right, it all influences us.
So you're saying even when we think we're being totally logical, emotions are messing things up.
Exactly. And the book has a great example of this. Schwager himself talks about a time when he was so focused on not trading that he ended up losing money.
He lost money because he didn't want to trade.
It shows how our desires can play out in weird ways in the market, right?
Yeah.
For Schwager, not wanting to trade made him hesitate, miss stuff, and then make rash decisions when he finally did trade.
So the lesson is, find a trading style that suits you, your personality.
You got it. If your style clashes with your natural tendencies, you're setting yourself up for failure. Someone cautious and analytical isn't going to thrive as a day trader, for example.
But I bet blindly following the crowd is a bad idea too, right?
Classic trap. Buy low, sell high. Sounds easy. But most people do the opposite. Get caught up in the hype, buy when everyone's buying, panic, and sell when things dip.
So be contrarian. Do the opposite of what everyone else is doing.
It's not that simple. It's about thinking for yourself, questioning what everyone's saying, not letting fear or greed call the shots. Schwager points out something funny. Often, financial magazine covers, the ones with the super bullish headlines, they tend to come out right before the market turns.
So when you see that magazine cover with the bull on it, maybe it's a sign to sell.
Not a foolproof rule, of course, but it shows that the best traders often go against the grain. They see what others miss and make their own decisions based on analysis, not on what the herd's doing.
All right, let's move on to another fascinating trader, Randy McKay. This guy was all about riding those long-term trends in futures, but his use of fundamentals was kind of different.
The interesting thing about McKay is he wasn't as interested in the news itself, but in how the market reacted to the news. He felt that watching how prices moved after certain events gave you insight into the market's underlying sentiment, what was really driving it.
So it's less about predicting the news and more about predicting how other traders will react to it.
Exactly. He knew the market is driven by psychology, by how people behave, and that could be more important than the actual news.
He was like reading the mind of the market.
Right.
There's a story about McKay almost doubling his money during the '87 crash. Everyone else was panicking, but he stayed calm, predicted a bounce. How did he stay so level-headed in all that chaos?
McKay had this incredible ability to separate himself from the emotional roller coaster of the market.
Okay.
He didn't let fear or greed get in the way, even when everyone around him was losing it. That's a hallmark of these successful traders, you know?
Makes sense, but easier said than done, I imagine. It sounds like having a system, a defined approach that you stick to would be key in those situations.
Absolutely. McKay was all about systems. He wasn't just winging it. He had a clear strategy for entry and exit, managing risk, riding the trend. That gave him a framework for making good decisions, even when things were crazy.
Let's switch gears a bit and talk about William Eckhart, another fascinating guy, but from a completely different background. This guy was a mathematician, but what's surprising is he was skeptical of using traditional statistical approaches in trading.
Might seem counterintuitive, but his skepticism came from a really deep understanding of statistics. He was especially wary of relying solely on the normal distribution, that bell curve we use for probabilities.
I'll admit, math isn't my strong suit.
Eh.
Can you break down what's wrong with using the normal distribution in the markets? It seems like that's the basis for a lot of risk models.
The issue is the normal distribution assumes those really extreme events are rare, way out on the edges of the bell curve.
Right.
But in trading, those rare events, crashes, spikes, they happen way more often than the model says they should.
So like the '87 crash, that should have been basically impossible according to that model.
Exactly. And yet it happened. And it showed the flaws in all those risk models based on the normal distribution. They made investors think they were safer than they actually were.
Makes you think. So what did Eckhart suggest instead? If the usual models aren't reliable, how do we understand the markets and manage risk?
He advocated for what he called the robust approach. It's not about ditching models entirely, but knowing they have limits. Market behavior can be way more unpredictable than those models suggest.
Okay, so how does this robust approach actually work? Is it more about gut feeling?
It's less about gut feeling and more about, I'd say, a scientific approach to testing if what you believe is actually true and being ready to change if it's not. Eckhart believed in always asking, does my model match reality, and being willing to adapt when it doesn't.
That makes sense, yeah. It's about being skeptical, not just of the market, but of how well you understand it.
Exactly. Knowing you don't have all the answers and the market's always changing, you got to be adaptable, humble, and learn from mistakes.
Okay, let's move on to a story that challenges this idea that trading is some innate talent you're either born with or not. The story of Richard Dennis and his turtles.
Richard Dennis was a legend who was convinced trading could be taught. To prove it, he got a bunch of total beginners, called them the Turtles, and trained them to trade using a system, rules-based.
Wait, he taught beginners a system, and they actually became good. What happened?
It was amazing. Years later, a huge chunk of the top-performing commodity advisors were former Turtles.
Wow, that blows the myth that you need some sixth sense to make it in the market out of the water. It sounds like the right training, discipline, and a solid system are what matter.
That's a huge takeaway from that experiment. Not everyone will become a wizard, even with the best training. But it shows a systematic approach with risk management and keeping your emotions in check can really boost your chances.
That's inspiring. But speaking of risk management, I'm curious, how do these wizards handle losses? They must have had some bumps along the way.
Losses are going to happen. It's how you deal with them that separates the good from the great. There's this story about Randy McKay, the trend follower we talked about, that really shows this. Remember his big win in the '87 crash?
Yeah.
Well, he also had a big loss in the Canadian dollar market that teaches a valuable lesson.
Oh, what happened? Did he misread something?
It wasn't really a misreading, but more a case of overconfidence. He'd been winning big, making tons of money, and he got complacent. ignored some early warnings, held a huge position when the market turned. Result, lost over $1 million in days.
Ouch. So even the best traders can fall victim to their emotions. That's kind of scary.
It shows you always have to be careful. You can't relax even when you're on a roll. McKay admitted he got caught up in the excitement of winning and stayed in too long, wanting even more.
So it's not just the system, it's sticking to it, even when you're feeling tempted to change things up.
Exactly. McKay's story reminds us that risk management is a constant thing. You always got to be paying attention, be self-aware. He learned the hard way that even the best plan is only as good as your ability to follow it, no matter what.
Okay, I see a pattern here. Discipline, emotional control, knowing your weaknesses. But some traders seem to have a more relaxed approach. What about Tom Basso? He seemed to have a more philosophical, even, dare I say, chill approach to trading.
Tom Basso is a fascinating case. Unlike some who are driven by making the most money possible, Basso prioritized lifestyle and peace of mind.
Okay.
He didn't want the stress of high-stakes trading. He wanted a sustainable approach that let him enjoy life outside the markets.
He sounds like my kind of trader. So what was his secret? Did he just avoid big risks and trade small?
He was definitely conservative with risk, but his real brilliance was his philosophy of detachment. He talked about seeing life like a movie. You only get to experience each moment once, so why stress about the market?
So he didn't let trading control his mood or how he felt overall.
Exactly. He had a system, he trusted it, and didn't get caught up in the day-to-day ups and downs. He even had a plan for dealing with stressful stuff, like the Gulf War.
Wow. That's impressive.
Mm-hmm.
Staying level-headed during a major event like that, I can't imagine. How did he handle it?
What's interesting is his first thought wasn't about profit, it was about controlling risk. He knew things would be volatile, and his priority was making sure his systems could handle it.
It sounds like he had a really mature and disciplined approach.
Yeah,
He wasn't looking for thrills, he was playing the long game.
absolutely. His story reminds us that successful trading doesn't have to be all stress and anxiety. You can be profitable and still have a balanced, happy life.
I get why you consider him one of the most successful. It's not just the money, it's living well.
Exactly. Basso challenged this idea that you have to sacrifice everything to succeed in the markets. He showed you can make money and still prioritize your well-being, enjoying the journey.
That's a powerful message for anyone in trading, or really any high-pressure job. Okay, let's talk about Linda Raschke, one of the few women in the book, and a master of short-term trading.
What's incredible about Raschke is her ability to spot and use those short-term price patterns most people miss. She's not trying to predict where the market's going in the long run. She's focused on those smaller but consistent profits from day-to-day changes.
So she's like a market surgeon, making precise moves to get those little gains.
That's a great way to put it. She compares herself to a skilled craftsman, getting better through practice and repetition, and just like a craftsman takes pride in their work, she aims to be profitable every single day.
That's ambitious. But it sounds like she has a system that lets her be really consistent.
She does, and a big part of that is her focus. She watches prices tick by tick, looking for tiny patterns and shifts that most traders wouldn't even notice.
That level of focus must be intense. I imagine it limits how many markets she can trade effectively.
You're right. She usually focuses on just a few markets at a time. That lets her really understand how they work, their quirks.
So depth over breadth.
Yeah.
Instead of trying to do everything, she masters a few things.
Exactly. And that deep knowledge is what lets her make those split-second decisions you need for short-term trading.
Speaking of intuition, there's a story about Raschke stopping trading for a bit because she was doing too well. She felt like she was on a roll and didn't want to push her luck.
That shows real self-awareness and discipline. It reminds us that even when you're winning, you gotta stay grounded, not let success make you overconfident. Sometimes taking a step back is the smartest thing you can do.
Like hitting pause to get your head straight. It's interesting that taking a break could actually help your trading.
It can, yeah. Helps you avoid those impulsive moves that come from being too confident or scared of missing out. Raschke's story also shows you don't need to catch every market move to be successful. She wasn't trading during the '87 crash, for example, and she still built a great career.
That's good to know. Even if you miss a big one, it's not over. There's always another chance.
A good way to look at it. And it brings up another point. There's no one right way to trade. What works for Linda Rasch might not work for someone else. The key is finding what fits you, your personality, how much risk you're comfortable with, and your goals.
Okay, let's switch gears and talk about Mark Ritchie, a trader whose story reminds us that market wizards can come from anywhere. This guy was a former divinity student who became a soybean trading legend.
Ritchie's story is wild, right? Started knowing almost nothing about markets, but he was incredibly curious and naturally good at seeing patterns, spent hours looking at charts, teaching himself to see the signs of future price movements.
And he wasn't afraid to challenge what everyone thought. He even questioned buy and hold investing.
He did. He believed more money was made by buying high and selling even higher. He was a trend follower all the way, all about riding momentum, letting profits run.
So he wasn't trying to time the market perfectly. He was looking for those big trends and making the most of them.
Yeah. He talked about catching the easy part of a trend, the part where the move is clear and strong, not trying to guess the very beginning or end.
Ritchie also had strong feelings about dishonesty in trading. He was especially critical of those boiler room operations where shady brokers take advantage of people.
Ritchie was big on transparency and accountability. He felt a lot of the dishonesty came from people being dishonest with themselves, ignoring their own bad behavior, not owning up to the consequences.
So he was calling for more self-awareness, not just about trading, but about being ethical.
Right. He believed the whole industry needed to police itself better, get rid of the people who are exploiting others.
It's good to hear a trader talk openly about the ethics of it all.
It is. Ritchie's story shows us that while there are definitely bad apples out there, there are also those who are committed to doing things the right way.
Okay, let's move on to a trader who chose to stay anonymous, the subject of a chapter called Zen and the Art of Trading. This one dives into the psychology of trading, how important it is to be in the right mental state for the market.
This anonymous trader had a unique take on detachment, the power of intuition, and letting go of your ego to let the market guide you.
Sounds almost mystical. Was he like a Zen master?
Not in the traditional sense, but he really understood the mental and emotional challenges of trading. He stressed how important it is to be clear-headed and calm so you can make decisions based on logic and intuition, not fear or greed.
So finding that mental balance where your emotions aren't controlling you.
Exactly. He believed the market reflects human psychology, and to win, you need to understand not just the market psychology, but your own as well.
He also talked about surrendering your ego to the wisdom of the market. What did he mean by that?
He meant you can't force the market to do what you want. You got to accept it, even when it's not going your way. It's about letting go of needing to be right all the time, knowing you'll mess up, and learning from those mistakes.
That's a humbling thought. The market doesn't care about your opinions or your ego. It's a force that rewards those who can adapt and change.
Very well said. And that leads perfectly into our next subject, Van K. Tharp. He's not a trader himself, but someone who spent years studying trading psychology and developing ways to help traders overcome their mental blocks.
So he focuses on the mental game, helping traders develop the right mindset.
Exactly. Tharp's work is all about this idea that what we believe shapes what happens, especially in trading. He says a lot of traders have beliefs that actually hold them back.
So it's not just about the strategy, it's about having the mental strength to follow through, even when it's tough.
Precisely. If you think trading is risky and you're going to lose, you probably will. Your beliefs make it happen.
So how do you break free from those negative beliefs? Is it just positive thinking?
It's a bit deeper than that. Tharp uses a bunch of techniques, including something called neuro-linguistic programming, or NLP, to help traders see those negative beliefs and change them.
Okay, you got to explain NLP. That sounds like sci-fi.
It's not sci-fi, but it is about reprogramming your brain, in a way. NLP techniques can help you change how you react emotionally to the market, get better focus, and ultimately make smarter, more rational trading decisions.
Like a software upgrade for your trading mind. Sign me up.
It's not a magic solution, but it can really help you trade better.
This deep dive has really opened my eyes. Trading isn't just charts and numbers. It's about psychology, both yours and the market's.
That's a great point. And it leads us to another important person in the book, Dr. Ari Kiev, a psychiatrist who worked with high performers, including traders.
A psychiatrist in trading. How does that fit in?
Dr. Kiev knew that trading, with all its pressure and uncertainty, can really affect your mental and emotional health. He saw that traders needed ways to cope with stress, anxiety, and the inevitable losses.
So he was like a performance coach for traders, helping them handle the mental side of things.
That's a great way to put it. He worked with traders to help them understand themselves, develop strategies for managing stress, and perform at their best while staying mentally and emotionally healthy.
This has been an amazing journey into the minds of some of the best traders out there. We've covered a lot, from strategies to psychology, and it's clear there's no one-size-fits-all answer for success in the market.
That's true. If there's one big theme here, it's self-awareness.
Knowing yourself, your good and bad points, how you react emotionally, that's just as important as knowing the markets.
Absolutely. And that self-awareness is a continuous process. You got to keep working on it throughout your trading career.
Well said. And on that note, we want to leave you with something to think about. If you were to create your own trading strategy, what would be its core principles? What would be the guiding philosophy that would help you navigate the complexities of the markets and achieve your financial goals? We'd love to hear what you come up with. Until next time, happy trading.
It's a great analogy. She compares her approach to like a skilled craftsman, honing their skills through practice and repetition.
Right.
And just like a craftsman takes pride in their work, she aims to be profitable every single day.
That's an ambitious goal.
Yeah.
But it sounds like she has a system that helps her be incredibly consistent.
She does, and a big part of that is her intense focus.
Okay.
She tracks price movements tick by tick, looking for these subtle patterns and shifts that most traders would completely miss.
That level of focus must be mentally demanding. I imagine it limits how many markets she can trade effectively.
Yeah, you're right. She typically focuses on just a handful of markets at a time.
Okay.
That allows her to really understand the nuances and idiosyncrasies, the little quirks of each market.
So depth over breadth. Instead of trying to be a jack of all trades, she becomes a master of a few select markets.
Exactly. And that deep, specialized knowledge is what allows her to make those quick, intuitive decisions that are so crucial for success in short-term trading.
Speaking of intuition, there's a story in the book about Rashka actually stopping trading for a while because she was doing too well.
Really?
Yeah, she felt like she was on a hot streak and didn't want to push her luck.
That's incredible. It really speaks to her self-awareness and discipline. It's a reminder that even when you're on a winning streak, it's crucial to stay grounded and not let success cloud your judgment. Sometimes stepping back and taking a break can be the smartest move.
It's like hitting the pause button to regain perspective.
Yeah.
It's interesting to think that taking a break could actually be beneficial for your trading.
Absolutely. It can help you avoid those impulsive decisions that often come from overconfidence or, that fear of missing out. Rashka's story also highlights that you don't need to catch every single market move to be successful.
Right.
She wasn't in the market for the 1987 crash, for example, and yet she still built an incredibly successful career.
It's comforting to know that even if you miss a big move, it doesn't mean you've blown your chance.
Right.
There's always another opportunity around the corner.
That's a healthy perspective to have, and it brings up another important point. There's no one-size-fits-all approach to trading.
Okay.
What works for Linda Rashka might not work for someone else.
Mm.
The key is to find a style that aligns with your personality, your risk tolerance, and your overall goals.
Okay, let's shift gears and talk about Mark Ritchie, a trader whose story is a reminder that market wizards can come from the most unexpected backgrounds. This guy was a former divinity student who became a soybean trading legend.
Yeah, Ritchie's journey is fascinating.
Right.
He started with almost no knowledge of the markets, but he had this insatiable curiosity and a natural talent for recognizing patterns.
Yeah.
He spent countless hours poring over charts, teaching himself to identify those subtle signals that foreshadowed price movements.
And it sounds like he wasn't afraid to question conventional wisdom.
Mm-hmm.
He even challenged the sacred cow of buy and hold investing, didn't he?
He did. He believed that far more money was made by buying high and selling at even higher prices.
Okay.
In other words, he was a trend follower through and through. He was all about riding momentum and letting his profits run.
So he wasn't trying to time the market perfectly. He was looking for those big established trends and riding them for all they were worth.
Exactly. He had this concept of catching the easy part of a trend, the part where the move is clear and strong, rather than trying to anticipate the very beginning or the end.
Okay. I like that Ritchie also had some strong opinions about the prevalence of dishonesty in the trading world.
Yeah.
He was particularly critical of those boiler room operations where unethical brokers prey on unsuspecting investors.
Oh, yeah. Ritchie was a strong advocate for transparency and accountability in the markets.
Mm-hmm.
He believed that a lot of the dishonesty stemmed from people being dishonest with themselves,
Right.
glossing over their own ethical lapses and failing to acknowledge the consequences of their actions.
So he was calling for greater self-awareness, not just in terms of trading strategies, but also in terms of ethical behavior.
That's right. He believed that the trading industry as a whole needed to do a better job of policing itself and weeding out those who were taking advantage of others for personal gain.
It's refreshing to hear a trader speak so candidly about the ethical dimensions of the profession.
It is Ritchie's story reminds us that while there are certainly bad actors in the trading world, there are also those who are deeply committed to ethical conduct and integrity.
Okay, let's move on to a trader who chose to remain anonymous, the subject of a chapter titled Zen and the Art of Trading. This chapter delves into the psychological aspects of trading, exploring the importance of aligning your mental state with the demands of the market.
This anonymous trader offered a unique perspective on the challenges of detachment, the power of intuition, and the importance of surrendering your ego to the wisdom of the market.
It sounds almost mystical. Was this trader a Zen master or something?
He wasn't a Zen master in the traditional sense, but he had a deep understanding of the mental and emotional challenges of trading.
Okay.
He emphasized the importance of cultivating a state of mental clarity and calmness, allowing you to make decisions based on logic and intuition rather than fear or greed.
So it's about achieving a state of mental balance, where you're not letting your emotions cloud your judgment or dictate your actions.
Exactly. He believed that the market is a reflection of human psychology. And to be successful, you need to understand not only the psychology of the market, but also your own psychology.
He also talked about surrendering your ego to the wisdom of the market. What did he mean by that?
He meant that you can't force the market to do what you want.
Right.
You have to accept the reality of the market even when it's moving against you.
Okay.
It's about letting go of the need to be right all the time, acknowledging that you'll make mistakes and learning from those mistakes.
That's a humbling concept. It's a reminder that the market doesn't care about your opinions or your ego. It's a force of nature that will reward those who are able to adapt and evolve.
Very well said. And it segues perfectly into our next subject, Van Catharp.
Okay.
He's not a trader himself, but someone who has spent years studying the psychology of trading and developing techniques to help traders overcome their mental barriers.
So his focus is on the mental game of trading, helping traders develop the right mindset for success.
Exactly. Tharp's work centers around the idea that our beliefs shape our reality, particularly in the realm of trading.
Okay.
He argues that many traders have limiting beliefs that sabotage their success.
So it's not just about having a sound trading strategy, it's about having the mental fortitude to execute that strategy effectively, even under pressure.
Precisely. If you believe that trading is inherently risky and that you're destined to lose money, then you're likely to fulfill that prophecy. Your beliefs create a self-fulfilling cycle.
So how do you break free from those limiting beliefs? Is it just a matter of positive thinking?
It's a bit more nuanced than that.
Okay.
Tharp utilizes a combination of techniques, including neurolinguistic programming, or NLP, to help traders identify and reframe those negative beliefs.
Okay, you're going to have to explain NLP. That sounds like something out of a science fiction movie.
It's not science fiction, but it is about reprogramming your brain, so to speak.
Okay.
NLP techniques can help you modify your emotional responses to market events, improve your focus and concentration, and ultimately make more objective and rational trading decisions.
It's like giving your trading mind a software upgrade.
Right.
Sign me up.
It's not a magic bullet, but it can be a powerful tool for improving your trading performance.
This deep dive has been a real eye-opener for me. I'm seeing that trading is not just about charts and numbers. It's about understanding human psychology, both yours and the collective psychology of the market.
That's a great insight. And it leads us to another important figure in the book, Dr. Ari Kiev, a psychiatrist who specialized in working with high-performance individuals, including traders.
The psychiatrist in trading. What's the connection there?
Dr. Kiev recognized that trading, with its inherent pressures and uncertainties, can take a toll on your mental and emotional well-being.
Okay.
He saw the need for traders to develop coping mechanisms to deal with stress, anxiety, and those inevitable setbacks that are part of the game.
So he was like a performance coach for traders, helping them manage the psychological demands of the profession.
That's a great way to put it. He worked with traders to help them understand their own psychological makeup, develop strategies for managing stress, and ultimately perform at their best while maintaining their mental and emotional equilibrium. That's a great way to put it. He worked with traders to help them understand themselves, develop strategies for managing stress, and ultimately perform at their best while maintaining their mental and emotional equilibrium.
It sounds like he was addressing a real need in the trading world. It's easy to get caught up in the numbers and forget that there's a human being behind those trades.
Right. It's not just about algorithms and spreadsheets. It's about people making decisions under pressure, and those decisions can be influenced by a whole range of emotions.
Absolutely. This deep dive has been an incredible journey through the minds of some of the most successful traders of our time. We've covered a lot of ground, from technical strategies to psychological insights, and it's clear that there's no single formula for success in the markets.
That's right. If there's one overarching theme that emerges from all these stories, it's the importance of self-awareness. Knowing yourself, your strengths, your weaknesses, your emotional tendencies, that's just as important as understanding the markets themselves.
Absolutely. And that self-awareness is an ongoing process. It's something you need to cultivate and refine throughout your trading career.
Well said. And on that note, we want to leave you with a final thought to ponder. If you were to design your own trading strategy, what would be its core principles? What would be the guiding philosophy that would help you navigate the complexities of the markets and achieve your financial goals? We'd love to hear what you come up with. Until next time, happy trading.